Hello again. We're often told that the best countries to invest in are those with the highest forecast rates of economic growth. But is it actually true? Perhaps surprisingly, the academics who've studied the evidence, including Professor Elroy Dimpson and colleagues from London Business School, say it's not.
When we wrote our book, Triumph of the Optimists, one of the things which we noticed was that if you looked at the cross-section of countries over more than a century, the ones which had had the highest economic growth actually had somewhat inferior stock market performance. That's a puzzle.
In his study, Is Economic Growth Good for Investors?, Jay Ritter examined data from 15 emerging markets between 1988 and 2011 and found there was actually a negative correlation between growth and stock prices. In China, for example, growth averaged about 9%, but stock returns averaged minus 5.5%. For Professor Dimpson, the crux of the issue is dilution. In other words, the benefits of economic growth are diluted between several different parties. The investor might not benefit at all.
It can be individual entrepreneurs who are creating businesses that add value to the economy. It could be people who have jobs who are getting better compensated for doing that work. It could be the government. It could be a country which is engaging in public works. Or it could be the corporate sector, but it could be the corporate sector that's raising funds, issuing shares. And so those are not automatically a benefit to current investors. Those may provide a benefit to future investors who buy shares in a company. So it's a more subtle, more nuanced issue than appears at first sight.
Another reason why investors are so often disappointed by returns from high-growth economies is simple market efficiency. In other words, projected growth rates are already incorporated into prices.
Investors operate in general internationally. They will be willing to pay more for shares in a high-growth scenario than shares in a low-growth scenario. And in paying more, there's less by way of upside for them. So the investment performance that they can gain from investing in a growing economy will not be any higher than you would expect as a fair reward for their investment.
So the next time you hear that such and such a country is tipped to enjoy stellar economic growth, don't be tempted to pile in. Having a balanced and globally diversified portfolio is always the best policy. Goodbye.